value proposition refers to the unique value a product or service provides its customers, explaining why it's worth their time, money, or attention. It highlights the benefits that make it stand out from competitors, addressing the customer's needs for solving a specific problem. In its introduction, the Bitcoin white paper specifically states the core problem it intends to solve, saying, the cost of mediation increases transaction costs, limiting the minimum practical transaction size and cutting off the possibility for small casual transactions. But why do we need to mediate transactions? What is the cost of mediation? Why is the limited minimum practical transaction size a problem? No physical assets are actually moved when electronic payments are made using digital communication systems like the internet. An electronic payment is simply an exchange of information required to authenticate each of the transacting parties and make a ledger entry in each party's account. This creates trust and coordination problems because neither party can be sure the other's information is genuine or that the transaction is accurately recorded in the other's account. This problem of achieving coordination between parties that may not fully trust each other is often referred to by computer scientists as the Byzantine generals problem. We typically solve this problem by introducing a trusted third party that vets users during registration and maintains privileged access to their accounts to ensure transactions are executed and reconciled correctly. You have likely seen customer pricing notices in your local stores, but the cost of mediation is not readily apparent in most of our purchases. The fees are often bundled into the price of goods or services, making it difficult for consumers to see exactly how much they are paying for mediation. The Congressional Research Service published a report on credit card swipe fees in October 2024 that breaks down the somewhat opaque process behind electronic payments. It gives us the number and value of non-cash transactions for 2015, 2018, and 2021. It also gives us some numbers for merchant rates that consist of interchange fees, network fees, and processing fees. Based on these numbers, we can estimate the cost of third-party mediation to range from 1.5 to 3% of the total transaction amount. Orbs.com published an ultimate guide to card processing fees in 2022 that concurred with these numbers. Let's put the non-cash transaction numbers from the congressional report in an Excel table so we can analyze them and get a better idea of what we are paying for mediation. We will use a 2.25% processing fee for our analysis. The report shows the total value of non-cash transactions in 2021 was more than $9 trillion, which would mean the total mediation fees paid would have been around $212 billion. If we divide the total fees by the total number of non-cash transactions in 2021, we see the average fee per transaction was roughly $1.30. A report published by the Merchants Payment Coalition in September 2024 confirms our analysis, saying credit and debit card swipe fees totaled $224 billion in 2023. The report also confirmed average swipe fees similar to what we use for our analysis. Let's compare these third-party mediation fees to Bitcoin transaction fees. We will get our Bitcoin transaction fee numbers from Coinmetrics, an open-source project founded in 2017 to determine the economic significance of public blockchains. We will look at the BTC and BSV average transaction fees measured in US dollars and compare them to third-party mediation fees and to each other. It is difficult to compare the two Bitcoin networks on this chart because the disparity in scale is too great. Let's export the data to Excel so that we can do a better analysis of the numbers. If we separate the date text into columns, we can easily filter the data by year and calculate the average fee for each year. To compare the numbers, we put the average fee for each year into a table. Let's quickly go through some historical notes to give our table some context. The Bitcoin white paper was first released to the Metsdow cryptography mailing list on October 31st, 2008. Bitcoin's Genesis block was created on 3 January 2009. Bitcoin first got a price in the spring of 2010 when BitcoinMarket.com listed it for 0.3 cents per coin. Coinmetrics data on Bitcoin transaction fees go back to July 18th, 2010. We see the average transaction fee for that year was about 0.006 of a cent. It trended upward for the next several years with a significant jump in 2017. Let's bring in our third-party data and compare fees up to this point. For this portion of our analysis, we're going to use the 2015 average third-party fee of $1.22 as a base, since we do not have data to compare each year individually. This will be less precise, but the average third-party fee volatility is low, and the variation would be relatively small across the years we are going to compare. When we divide our third-party base fee by the average annual Bitcoin fee for each year between 2010 and 2017, we see that Bitcoin fees started out being roughly 20,000 times less than third-party fees. But as Bitcoin fees trended upward, they quickly got closer to third-party fees and jumped past them in 2017 when the average Bitcoin fee became almost 4 times greater than third-party fees. These high fees were the main factor behind what is commonly referred to as the Blocksize war and the eventual split in the Bitcoin blockchain. Before we continue our fee analysis, let's take a quick look at why the dispute is known as the Blocksize war, why the fees went up so much, and how the network split. On July 15th, 2010, Satoshi made an update to Bitcoin client software that limited the block size to 1 megabyte. Satoshi never explicitly said why the limit was implemented, but it was likely intended to be a temporary measure to prevent spam and potential denial-of-service attacks. In October 2010, a thread about increasing the limit was started in the Bitcoin forum with the comment, "We should be able to at least match PayPal's average transaction rate." This comment was made because a 1 megabyte block would only be able to hold about 4,000 transactions at best. This limit made it impossible for Bitcoin to serve as an electronic cash system. Satoshi and early Bitcoiners knew the limit would prevent the system from scaling, but they also understood that spam and denial-of-service attacks would become less economically feasible once Bitcoin's value stabilized, at which point the limit could be removed. Satoshi did make 2 posts in this thread indicating his intention to implement a phased approach to increasing the block size as needed and at designated block heights so that miners would have time to update their software. Satoshi stepped away from the project shortly after these posts without having implemented the updates. Bitcoiners continued to debate the block size limit, but it didn't become a practical problem until almost 5 years later when users tried to put more than 1 megabyte worth of data into a block for the first time. By the end of 2015, blocks began reaching the limit more frequently, and transaction congestion reignited the block size debate. The side that wanted to keep the 1 megabyte limit, known as small blockers, made the argument that a large number of transactions would be too difficult for regular people to validate. They believed the system would be less trustworthy if only large companies were capable of validating every transaction. The small blockers did understand that the limit made it impossible to use Bitcoin as a payment system, but argued that it should be used as a store of value instead of electronic cash. To deal with the transaction bottleneck, the small blockers who had permissions to edit Bitcoin's GitHub repository added the opt-in replace by fee code on November 27, 2015. This code enabled users to rebroadcast their transactions with higher fees and allowed miners to prioritize which transactions got into a block based on who paid the most. This code was part of the Bitcoin Core release 0.12.0 on February 23, 2016. Limited block size and replace by fee mechanism is part of the reason Bitcoin Core fees are so high and volatile. The developers and miners who wanted to raise or remove the block size limit, often called big blockers, created their own implementation of the node software known as Bitcoin ABC. On August 1, 2017, the 2 groups, BTC running Bitcoin Core and BCH running Bitcoin ABC, began building different chains on top of block number 478,559. The block size debate continued within the big blocker ecosystem, as some advocated for even larger limits or complete removal of the cap. Those favoring unlimited scaling created another implementation called Bitcoin Satoshi Division. On November 15, 2018, Bitcoin Cash and Bitcoin SV split at block number 556,766. We go back to our fee analysis. We see that raising the block size limit on the Bitcoin SV chain in 2018 resulted in transaction fees going back down to a fraction of a cent. Since the split, Bitcoin Core transaction fees have consistently exceeded those of third-party payment networks. If we use 2018 as our base for third-party fees after the split, we see the gap peaked in 2021 when Bitcoin Core fees were more than 7 times higher than third-party fees. It briefly narrowed in 2022, but were over 3 times greater than third-party fees in both 2023 and 2024. When we compare the average Bitcoin Core fees to Bitcoin SV's transaction fees, we see that BTC fees have been orders of magnitude greater than BSV since the split. Bitcoin Core's block size limit makes it impossible for miners to handle a tiny fraction of the daily transactions processed by Visa, MasterCard, or PayPal. BTC could not serve as a global payment system no matter how high the fees went. But we must also remember that Bitcoin Core is now supposed to be a store of value system, which is a fundamentally different thing than an electronic payment system with a fundamentally different value proposition. So comparing BTC fees, Visa, PayPal, or Bitcoin SV is like comparing apples to oranges. Let's focus on Bitcoin SV as a peer-to-peer electronic cash system and compare its transaction fees to our current third-party mediation system. This comparison shows the average BSV fee has been significantly lower than third-party fees since the split, and in 2023, they dropped below what they were when Bitcoin first got a price in 2010. Coinmetrics only had BSV data up to 7 August 2023, but at that point, the average third-party fee was almost 25,000 times greater than the average BSV fee. If we go to the Bitcoin SV Block Explorer, What's on Chain, we can get current data on the average BSV transaction fees for the year to date and see that most of the average daily fees since October 2024 were lower than the average fee from any of the previous years. This shows that BSV transaction fees have been trending downward since 2021. Considering the hundreds of billions of dollars we pay in mediation fees every year and the cost efficiency of Bitcoin SV, we can conservatively estimate that transitioning to a global BSV payment system would reduce consumer costs by tens of billions of dollars annually. This is not an insignificant amount to save, but is the least significant aspect of Bitcoin's value proposition. The real added value of such an efficient system would be found in the new economic models made possible by lowering the minimum practical transaction size. Bitcoin's greatest value proposition might be in its ability to decentralize today's vertically integrated Web 2 and enable peer-to-peer commerce in the next generation of the World Wide Web. To explore this idea, let's look back at how Napster broke the peer-to-peer nature of the first-generation web and led to the vertically integrated system we have today. Napster didn't actually break Web 1, but it did expose a critical problem with the late 90s, early 2000s internet. It had no economically viable way to monetize peer-to-peer exchange. Napster, founded in 1999, provided an indexing service that enabled internet users to share files peer-to-peer. The site was focused on MP3 music files and had tens of millions of users within its first year. Each user could copy dozens of files a day, but every song copied was an infringement on an artist's intellectual property. The mass copyright violations led to Napster being sued and shut down in 2001. File sharing platform demonstrated the power of digital distribution, but its shutdown highlighted the need for a legal framework to conduct commerce in digital goods and services. This type of digital distribution framework would need a mechanism to pay content creators for their work. This is where the high cost of third-party mediation grounded to Ronald Coase's theory of the firm and the Web 2 centralization begins. In 1937, the British economist Ronald Coase published The Nature of the Firm, where he asked a simple but profound question. If markets are so efficient, Why do firms exist at all? His answer was that every exchange carries a transaction cost, the friction of finding information, negotiating, and enforcing agreements. His transaction cost framework explains why certain industries centralize around dominant players. When the cost of countless small transactions is too high, consolidation becomes the rational outcome. Decades later, in 1991, just as the World Wide Web was beginning, Coase was awarded the Nobel Prize in Economics for this insight. And another decade later, the rise of firms like Google, Facebook, Netflix, and the revival of Apple would once again prove his theory correct. It may have been technically possible to model a legal framework around an indexing service like Napster that enabled peer-to-peer distribution while negotiating and enforcing agreements that compensated artists for their work. But the cost of settling each individual transaction made such a model impractical. Payment networks like Visa and PayPal were designed to handle a relatively small number of transactions, not millions of micropayments for 99-cent songs. The cost of processing each payment would have exceeded the value of the good itself. Since small casual payments were prohibitively expensive, monetization models had to be built around centralized firms that could internalize those costs. Two dominant models emerged, the subscription model and the advertising model. iTunes, launched in 2003, made it easy for users to purchase a song for 99 cents. On the surface, this looks similar to the Napster model of acquiring a single song, but in reality, it was only economically feasible because Apple's centralized distribution, negotiated licensing agreements with major record labels, aggregated millions of transactions and bundled payments through its existing billing infrastructure. This centralization lowered the effective cost of transacting for consumers and rights holders. Spotify, launched in 2006, used a more straightforward subscription model. Instead of owning individual songs, users paid for unlimited streaming. This shifted music consumption from ownership to access, but still relied on centralized firms to negotiate rights and manage scale. The second dominant model was advertising. Platforms like Google Search, Facebook, and YouTube offered free video services that attracted users by removing payment barriers altogether. Then they monetized the user's attention by selling it to advertisers. This model also favored centralized platforms and controlled ecosystems because only firms with massive user bases could attract significant ad revenue and build the data infrastructure to target ads effectively. Together, these shifts mark the transition from the decentralized peer-to-peer Web 1 to the vertically integrated Web 2 built on centralized subscription and advertising models. Web 2's defining feature was large-scale interactivity, but without a micropayment system, that interactivity could only be achieved through centralized firms. This is the problem Bitcoin was designed to solve. Let's use the Bitcoin statistics and services site, CoinDance, as another source to show how low BSV fees are. If we scroll over the information icon in the Bitcoin SV transaction fees section, we see that BSV miners charge about 7/10,000ths of a cent to put a byte of data on chain. Fees this low would make it economically viable to build a peer-to-peer digital distribution system that settles a micropayment along with every exchange of a digital good. But what about the other transaction costs Ronald Coase talked about? Finding information, negotiating, and enforcing agreements. We've been using electronic data interchange to reduce friction in these areas since the 1970s, but these also come with third-party mediation fees that can be significantly reduced on the blockchain by setting additional conditions that must be met for a transaction to be valid. These types of conditional transactions are what people are referring to when they say smart contracts or programmable money. This is also what Satoshi was referring to in the white paper when he said routine escrow mechanisms could easily be implemented. On Bitcoin SV, digital goods can be tokenized with programmable conditions. Each peer-to-peer copy of a song could trigger a micropayment with Bitcoin script conditions that would automatically split royalties among artists, collaborators, platforms, and anyone else. An indexing service like Napster will ensure only tokenized, licensed files are shared so that real-time royalty settlement can happen for less than 1 cent in transaction fees. This type of distribution model can be built around all digital content: images, graphics, news articles, books, videos, movies, and anything else. With fees of 7/10,000ths of a cent per byte, it would be economically feasible to create payment channels that settle a transaction with every packet of data sent over the internet. Bitcoin's design can even help us keep artificial intelligence in check. In the year 2000, Napster enabled people to commit millions of copyright violations a day. In 2025, AI is helping us to commit more copyright violations than we can even track. Bitcoin SV's latest software update, known as Terranode, has demonstrated the ability to process 1 million transactions per second. The computer scientists and architects who designed the software have stated their intention to push the system well beyond that benchmark. With this scalability and cost efficiency, we can potentially tokenize every bit of data on-chain to cryptographically prove ownership of that data and give the owner complete control over it. Bitcoin's ability to break down vertically integrated systems goes beyond the large internet corporations mentioned above. Costs of transacting in other markets, like electricity, can also be reduced by tokenizing and exchanging those commodities on-chain. The Megawatt white paper by Binary Distributed Technologies explains how advancements in distributed energy resources promise resilience, but their potential is undermined by centralized data infrastructure and outdated market settlement mechanisms that slow coordination, increase transaction costs, and perpetuate single points of failure. The Megawatt paper proposes a decentralized framework leveraging Bitcoin to eliminate reliance on centralized data infrastructure by allowing peer-to-peer transactions to settle programmatically, with the Satoshi acting as a universal unit of account for tracking, automating, and auditing power flows. Other assets such as oil, gas, metals, agricultural products, land and real estate, stocks and bonds could all benefit from this type of framework that programmatically tokenizes assets onto an efficient, immutable, and scalable public blockchain. In his remarks at the University of Missouri on April 4, 2002, Ronald Coase said that economic systems will rearrange to become more efficient and productive when transaction costs are lowered. This is Bitcoin's true value proposition. Its design gives us a solution to the Byzantine generals problem that is efficient enough to reduce transaction costs in a way that will cause our entire economy to rearrange into a more open and productive system.